Most people think banks lend out money that other people deposit. That's not how it works. Banks don't lend money they already have. They create new money when they issue loans. And once you understand that, the entire financial system looks different. This is Money Mechanics. Today, we're breaking down how banks actually create money and why the system is structured this way. The common story sounds simple. You deposit $1,000. The bank keeps a portion and lends the rest to someone else. Logical, but outdated. Modern banking doesn't operate like a piggy bank. When a bank approves a $10,000 loan, it doesn't transfer money from someone else's account. It creates a new deposit in your name. On the bank's balance sheet, the loan becomes an asset. The deposit becomes a liability. Assets increase, liabilities increase, the system balances. But the total money supply just expanded. New money entered the economy. In most modern economies, the majority of money isn't printed by governments. It's created by commercial banks through lending. That means private institutions expand and contract the money supply every day. Why does this matter? Because if money is created through debt, then debt isn't just borrowing, it's expansion. When lending increases, economies grow. When lending slows, economies contract. Credit cycles drive booms, and they drive recessions. Banks are incentivized to lend. They earn money through interest, fees, and risk pricing. But they also manage default risk. Too much lending creates instability. Too little lending slows growth. The system requires balance. Central banks influence this system by adjusting interest rates and liquidity. But they don't approve individual loans. Commercial banks decide who receives credit, which means they influence where new money flows. Housing, businesses, consumption, infrastructure. And when loans are repaid, the process reverses. Assets decline, deposits decline, money is destroyed, not physically, digitally, through accounting entries. Banks don't lend deposits. They create deposits when they lend. They are not storage vaults, they are credit engines. And credit is the fuel of modern economies. If you want to understand how money actually moves through the system, subscribe. Next, we break down how credit card companies turn consumer debt into a high-margin machine. This is Money Mechanics.